I'm Charlotte McLeod with investingnews.com, and here today with me is Chris Temple. He is founder, editor, and publisher of The National Investor. Thank you so much for being here. Always great to have you.
My pleasure. It's nice to see you again, Charlotte.
Yes, so really good to be catching up with you. I can't believe it's been about 6 months since our last conversation, so there's a lot for us to go through. I thought we could start with a pretty broad question just to set the scene a little bit, which is, of course, we've seen gold moving since we last talked. Where would you place gold in the overall cycle right now?
You know, gold for a while, Charlotte, has been marching to its own tune. It is all of the traditional relationships, whether toward its younger sibling silver, whether toward the dollar, the bond market, whatever, it's just broken. And I don't mean that in a bad way. Gold is being sought more than it has been in many, many years as a safe haven asset. And there's a lot of people that are starting to understand that the era of financial repression, where all the central banks in the world, Japan was the first 30 years ago plus, but everybody else joined in since then. This whole idea of keeping interest rates jammed down but continuing to inflate, it's reached its saturation point. You just can't go on anymore. And without getting too deep into that, I think that the best object lesson for my point, Charlotte, was a week ago when in the first full day after the bombs started falling from Israel to Iran and then in the opposite direction, every asset class behaved as it normally does when you have these things from time to time, except for the U.S. Treasury market, which managed mere minutes of a rally as I was watching it overnight when the news broke. And then from the overnight hours all through the next full trading day, treasuries were selling off with the prices going down and interest rates going higher. And that tells you that the bond market understands that Washington is so broken and the debt situation is so bad, and it varies in degree compared to other countries, but everybody's in the same boat, that's why gold all of a sudden, and in this example, it really underscores this, gold is the safe haven now even more than treasuries. And I don't think a lot of people ever thought they'd see that again.
Lots of points for us to pick up on here, and we can go a little bit deeper down the Treasury path. So you're mentioning this response to all the turmoil we've seen in the Middle East. I know the Treasury market has also been responding to the big, beautiful bill. So that's making a lot of headlines. Anything you would add on that note that we should be aware of?
Well, for all of the bluster and insistence from President Trump that he has to have his one big, beautiful baseball, hot dogs, motherhood, apple pie, and the flag bill all passed in one fell swoop just because he said so, doesn't look like it's going to happen. And that's problem number one. Problem number two is by the time that the Senate and the House realize that they should go back to what their plan A was, and break out the tax bill, which would make permanent the 2017 tax legislation, which is the big, thing that they don't want to have expire. Every single Republican in the House and the Senate would vote for it. They would have voted for it 5 minutes after it was introduced, and the president would long since have signed it. And then the Congress in the U.S. here would have got back to work to see if they're really serious about reducing spending. And then maybe the Treasury market would be better behaved, but we didn't get that outcome. Instead, we've got this muddled mess where it's going to be still from now an extended fight to get this thing passed. They're probably, and if I had to bet money on it, I would say the odds favor they're going to have to break the bill up to get the tax cut passed. But even if they don't, by the time they get done what the president wants and what the House and the Senate agree on, guess what? We're at the end of the current fiscal year in September. Now we've got a debt crisis if they don't figure out how to increase the debt ceiling, which expires before September. And then we're going to be told once more by the House Speaker, Mike Johnson, well, you know what? We used up so much time and energy on this. We don't have the individual spending bills done. So guess what? We need to have another continuing resolution to continue to fund the government, just like we have all this year, at Joe Biden obscene post-COVID spending levels. And then the president carps about interest rates and the Fed won't lower interest rates and whatnot. Well, look in the mirror because you've enabled this. You know, you could have done a much better job of leading Congress and actually cutting spending. But people don't understand, Charlotte, that the Republican spending bills in the House and Senate and what the president plans on doesn't start in its projections from the current, I'll use a round number now, 37 trillion. We had a Tiffany, drum roll or something like that. It assumes that in the next decade, we're going to add 20 plus trillion more in debt. So the base case for this legislation is in a decade, we're going to have $58 trillion of a national debt. And so when you hear these numbers being thrown out like, well, the tariffs will bring in 2.8 billion. Oh, goody. But that's not 2.8 billion off of 37 trillion now. It's 2.8 billion off of the 58 trillion a decade from now. Likewise, the other things you see. So the Treasury market is behaving as it is. And we're on our way back to the 1970s for people who are old enough like me to remember that, because they see zero seriousness when you get right down to it on the part of the president or on the part of the Republican leadership in Congress to do anything that's going to really move the needle. And for people who remember the 70s, those were when Treasury bonds got the nickname of return-free risk. Okay, not risk-free return, return-free risk, because you're guaranteed to lose purchasing power with Treasury bonds. And that's where you're at again. And it puts us in a bad place because unlike the 70s, when we didn't have the accumulated national debt that we do, now we have that 37 trillion and counting problem. And that's why the Treasury market doesn't like anything that it sees. And that's why interest rates aren't coming down, despite economic news and then the latest geopolitical news that typically would push long-term market rates down. And it's why, conversely, gold is getting a bid. And that's the asset where people more than anything now want to buy the dip. At those transient times you see gold correct, doesn't correct for very long because people see where this is going.
Yes, I think all of these circumstances in the world, certainly it all comes back to coming out well for gold. And we'll talk a little bit more about gold. But before we go there, before we turn the camera on, you're talking about the end game for financial repression. And I thought that was an important concept to talk about. And I'm sure it ties into what you've already been going over. But can you explain what you mean by that and what you see coming?
Yeah, Charlotte, the term financial repression has pretty much been used since the wake of the financial crisis in 2008. And it essentially refers to, in Japan, it was full-blown yield curve control when Japan was in outright deflation of their economy and asset markets and so forth. And so they pushed by hook or crook, they would push down interest rates all across their yield curve to zero or for a long time below for a lot of different paper. In the U.S., in the wake of the financial crisis in 2008, we were introduced to what they called quantitative easing, which accomplishes somewhat the same thing, where in this case, the Federal Reserve announced that they were going to spend X per month to buy bonds to basically give artificial demand for Treasury bonds. And of course, when you buy bonds, you push the market yields down when you have more demand for the bonds. And, it kind of goes in the opposite direction, the price of the bond or the value of it and the interest rate level. So we've had that going on for a while. The Fed got away with it for a long time, then started to lose control a couple of different times. Now we're at a place where we have not overtly, for a little while now, had quantitative easing. In fact, for public purposes, when you look at the official number, the Federal Reserve has reduced its balance sheet by a fair bit since its peak about a year and a half, 2 years ago, whatever it's been now. But what has happened recently, Charlotte, is that they have had to step in with their open market operations and buy some chunks of Treasury auctions in the recent past so that the interest rates in the market didn't spike too much. Because you're at a place right now where the sheer volume of the debt. We're adding another 2+ trillion to the deficit in this current fiscal year. There's several trillion that's rolling off of past issuances that needs to be refinanced, and now at significantly higher rates. And nobody is suggesting at any point that the U.S. is going to, quote, default or anything like that. But it comes down to the most basic math of supply and demand. And if there's too much supply of Treasury paper or anybody's paper, Japan has been living through this recently because you've had a bigger rebellion proportionately in the last few months in the Japanese bond market than you have even with Treasuries. But when you've got such an overwhelming supply against a market where the demand is lukewarm because people see that the budget's not getting fixed, inflation's going to turn around and move a bit higher, according even to the Fed itself in their meeting this week, then you're going to sit on your hands for a while and say, all right, well, I don't like interest rates where they are. The Treasury right now, the market is 4.4% to round it off on a 10-year Treasury. I don't know if I like that going off, but 5%, 5.5%, maybe I'll buy a little bit. And so this is the market at work, and from the president to his cabinet and everybody else, they're all rah-rah for free markets until they have to answer to the bond market. Now they don't like free markets. And so I'm honestly looking for, sooner rather than later, an attempt on the part of the Fed and or the Treasury to not just reinstitute quantitative easing if things get worse in the economy, but maybe to try a Japan-style yield curve control, which would be challenged. I don't think it would go over as well as it did in Japan for a whole host of reasons.
Right. I definitely had in mind to ask you about the Fed because, as you mentioned, we did just have the latest meeting and rates stayed unchanged. I don't think that was a surprise to anyone. But a lot of the time, the thing to really watch or listen for is the commentary from Powell. So anything further you would pull out from what Powell said after the meeting that you found noteworthy?
Well, here's the big question and tacit policy change, Charlotte, that the statistics laid out, but that Jerome Powell was loath to actually come right out and admit in so many words. There has been a debate for a while that at some point the Fed was going to have to run up the white flag and say, you know what, we have to be less obsessed with our 2% inflation target. Maybe we're not going to quite get back there, and we can't risk damage to the economy or staying too long or me being called too late Powell by President Trump any more than I already am. Okay. And we're going to have to abandon our 2% target and maybe be a little bit more flexible. He didn't come out and say that, but the consensus still, although it was extremely close, is barely still for 2 25 basis point rate cuts in the balance of 2025. Whether we get them or not, who knows? That's the current snapshot, which may well change. But that's against a backdrop of admitting for the second, SEP, Summary of Economic Projections, set of numbers in a row, that inflation is going to continue to move back higher, that we've seen the best numbers for inflation. At the same time that GDP slows a bit. So, okay, you just told us that your favorite inflation number, which is a lot of smoke and mirrors to begin with, is going to go back up to north of 3%, which is what they said yesterday. And yet the consensus is you're going to lower interest rates twice in 2025. So he did everything but come right out and admit that the 2% inflation target isn't going to be reached and can't be. It's a matter of simple mathematics, unless we have a global depression or another self-inflicted shutdown of economies for some reason. Then maybe for a little while we go lower than that when demand crashes. But look, the Fed and everybody else has printed just so darn much money that's what happens when you print all this money is you got inflation. And it is ticking back up, just like what happened in the mid-'70s after you had a big spike, inflation fluttered down, the Fed declared victory prematurely, and then had to raise rates even more aggressively later. They won't do that this time. They can't raise rates a whole lot. they'll try some tinkering to force yields down, like I said, through yield curve control or something like that. So that to me is the most telling thing that came out of the meeting. Aside from that, nobody was expecting them to change interest rates yesterday. Nobody was expecting Powell to say, well, I guess the president's right. Maybe I should move sooner rather than later. He's still keeping things close to his vest. There's too much uncertainty. I think that a lot of what he's potentially blaming tariffs for are self-serving. I don't think that tariffs, in my view, are automatically inflationary to the extent the Fed does, because they will also serve to correct demand. And there's already evidence. There's a news story, in fact, this week, Charlotte, that some of the European automakers have been cutting prices by double digits and exporting cars to the U.S. to help compensate for the tariffs, and simply because they're trying to move inventory that they've got too much of. And that's especially true with China, which China and their domestic economy has been in full-blown deflation. And they got stuff piled up on the shelves everywhere, everything imaginable, and they're trying to move at whatever price they can get. So there are some things like that will mitigate the overall global inflation impulse. But here in the U.S., we did it to ourselves just by allowing this same guy, who is such an irony right now that Powell is the only one with his finger in a dike, at least acting like he's trying to hold the fort so you don't have a total disastrous rebellion in the bond market. And yet he was the guy that started this all in the first place with all the money he printed after COVID. So in a way, he's getting what he deserves too.
There's definitely an art to reading between the lines there. So thank you for going into what you saw from Powell and the Fed. I wanted to also ask you about the overall health of the U.S. economy, because when we talked 6 months ago, you were saying, all right, the U.S. technically has avoided a recession, but for something like 2/3 of the country, they're already living in that, and they're seeing even stagflationary circumstances. So how are you feeling about that right now, 6 months later?
That big picture, I think, has not changed a great deal until just the recent past, when they popped back up a little bit in the last couple of weeks. For most of 2025, the consumer sentiment surveys have been lousy. Forecasting much higher inflation, worried about the future, worried about present conditions as well, et cetera. It's a little bit less bad right now. But I think that big picture has not changed appreciably from when you and I last spoke, that you've still got at least a small majority of the U.S. that is living paycheck to paycheck. They still see stress in living costs. I was reading one article the other day, for example, about how in not only for health insurance and healthcare costs, but even still for housing, that the official inflation numbers really understate what the story is. Yes, there's been a bit of a break, which is now probably over, on fuel and gasoline prices. The gasoline price has been a little easier to handle in the recent past, thankfully. But now we're up $15, $16 a barrel off the low for crude oil. And as Jeffrey Gunlock of Double Line pointed out in his post-Fed interview yesterday, he said that, well, one of the several reasons why the Fed is admitting, one of the things they do admit, that inflation is going to tick back up, at least somewhat in the months immediately ahead, is that every $10 a barrel jump in the oil price adds 0.4% to the headline CPI number. They find ways to mitigate that in their so-called core indices and things like that. But it is going to be part of the equation of inflation percolating. So I like the takeaway that one commentator had, summing it all up. Powell and his crew yesterday went from stagflation light to stagflation medium with the numbers that they put out.
Okay, that is a good way to sum it up. I think I can definitely see what you mean there. So these are all factors that are stacking up for gold on the positive side. Anything else that you are watching when it comes to gold? I'm sure there's many things, but any other key metrics that you're looking at? And I'm also curious, if we put all this together, where are you seeing the gold price going in the rest of 2025?
Gold has already had such an incredible run, but one thing to keep in mind, and I think you and I probably have talked about this a time or two in the past, there has been relatively little involvement, even to now, from Western retail investors in this move. This has been overwhelmingly led by central banks and large funds. There's been more physical demand for the metal, not so much from, quote, investors per se, but just from Joe Sixpack and Sally Soccer Mom and Uncle Fred that wants to buy a little bit of gold and squirrel it away. I mean, it's been well chronicled that even when you can buy gold in retail settings like Costco stores here in the U.S., they can't keep it on the shelves. There's been very high demand for that. But traditionally, the big needle mover when you've got these larger swings in markets and market sentiments has come from investors who are buying ETFs and buying the larger gold stocks and then ultimately working their way down the food chain and buying the better exploration stories. We finally started in recent months to see some of that where it's deserved. There have been some really nice moves in a number of companies. Nowhere's near what I would expect still to come down the road when you really have a mania and when everybody is buying gold, and when your taxi driver and Uber driver and shoe shine boy are telling you about the gold stocks they bought, then you'll know it's time to sell. But we're far from that. And I was at the SME conference in New York a month ago, rather, and a good friend and colleague, Mike McGlone from Bloomberg, who's their commodities analyst, who I know you know. I loved his number and the way his take was. And he said, if not an extreme prediction, but if things simply go to where they reasonably should in the next several months or year or so, he sees, and I agree, the S&P 500 and the gold price meeting both at 4,000. I might even bump it up and say 4,500 because I don't think the S&P would go down necessarily to 4,000. And I think gold has got a better shot at doing better than 4,000 in the next year. But I don't put numbers on it as much beyond that, Charlotte, as I do. I simply look at the factors causing this move, and they are still, in my opinion, in their early stages. So I think that this is open-ended to me.
I think that's a reasonable number, though. So thank you for going into that. And I'm wondering, I always am curious about the Western investors and when we might see that interest come back in, or maybe why it's not there quite yet. Is it maybe the economic situation, or people are still interested in stocks? What are your thoughts?
Well, you just mentioned it. You and I visited about this before, and I said that if you go back and you look at the last time you had the real rising tide lifts all boats for even the garbage lifestyle precious metals companies, it was 2009, 10, and into early 2011. And the biggest reason why was that nothing else was working, because everything else was so broken in the wake of the financial crisis back then. The stock market wasn't going to get out of bed right away. Real estate was busted for a while. The economy was in the dumps. And the Fed was printing all kinds of money. And like I said earlier, they decided back then out of necessity to introduce the world to quantitative easing from the Fed. So when you saw all of that, but all of that newly created credit wasn't having any traction right away anyplace else, then by default, it went into the path of least resistance, gold and silver. Silver hit $50. Gold at the time was nearly 2,000 before it peaked. Gold is higher now, but gold stocks still are a third or so, give or take, off of even their highs from 2011. And the reason for that chiefly is because enough other things still are working. Bitcoin might be volatile. I have zero interest in Bitcoin, never been in it, never intend to be in it, okay? Because of a lot of reasons that are way beyond our subject today. But that said, for the people who get into it, it's back over $100,000 for Bitcoin. Some of the other crypto stories work. The AI stock themes are doing well, and enough other things are that retail investors simply right now have too many play toys. So that's the biggest reason why. And secondly, like I was visiting with a mining executive of a company that's my newest addition now to my recommended list. We were visiting today, just kind of talking shop. I said, the other thing that really has hurt this industry in the eyes of Western retail investors especially, is that if you go and you're a novice, you don't know a lot about gold, but you do know that you've seen enough on TV that gold is hitting a new record after new record for a while now. Well, gee, maybe I should think about it. And so you Google the subject of gold, and the first thing that comes up is one of these snake oil salesmen telling you you need to buy gold and do it this way, or you're going to lose your bank account and you're going to get BRICS currency to replace it, or some of these other cockamamie come-ons that are out there that frankly have given the whole industry in the U.S. a very bad name from some of these promoters. So there's also that to overcome. But I think that inevitably, as it sinks in, because there's still an astonishing, to me, level of this Pollyanna type of attitude in our markets, Charlotte, where you look at what's going on on the ground with the debt situation. Elon Musk, predictably couldn't hang around for that anymore because his time was thrown away by the president who brought him in the first place to try and whittle the government down to size, and certainly by Congress that never had any intention of acting on much of any of this stuff. And you look at the fact that the stock market especially is nowhere near priced for even the best possible environment going forward, which is going to be a slower economy, chronically higher inflation, chronically higher interest rates. No, they're probably not going to go back to double digits like they were in the 70s and early 80s. But the stock market is priced as if we're going back to a 2% federal funds rate and 2% inflation, and we're not going to get either. And so when that starts to sink in even more, is probably going to be when this whole one big beautiful, et cetera thing really crashes and burns, or they don't do much beyond that and spending continues to go up and the bond market rebels. Then I think we're going to start to see more of a move on a part of retail investors into gold and gold stocks again. But that's what it's going to take first, is their present play toys have to be called into more serious question.
It definitely makes sense when you lay it out that way. And I have one more point I want to ask about on the gold stocks. So you mentioned they're starting to move. There's some interest trickling down. Mm-hmm. For you, when you look at the gold stocks, where do you see the most opportunity right now, considering that we still need to see probably more catch up there?
I'll tell you what's really good and really healthy is that the gold stocks, for the most part, that I have seen move, and I talk about both the producers and explorers, they're the ones that most deserve it, that have the best fundamentals. The people who are engaged now, smartly, before the big crowd comes back in, there's two themes. One is show me the money. Okay, forget about the fancy drill holes and the fancy assays and all the bluster and bombast and BS and everything and the fancy booth at the conference. Okay, what's the bottom line? What are you making? And there's been a couple of really killer stories recently of companies that, had a project that was okay, low grade, open pit, low strip, no rocket science, very simple meat and potatoes thing. That 22, 23, 2400 was so. Now they're swimming in money with gold at 33 or 3400. Didn't do anything different except enjoy a new gold price. That's getting recognized. And the other things that get recognized are not only the better exploration stories, but the ones that have demonstrated they can raise money. Because I'll tell you, folks, if you're watching this and you're following any kind of junior company, where we're at right now in the marketplace is good enough so that if the company that you're following legitimately has a good project, good prospects, if their management is well regarded, they don't have that much trouble raising money right now when they need it. So a good litmus test right now, especially for the explorers, is if you have somebody whining that the market's lousy, they can't raise money, it's because they probably shouldn't be getting any. So two things. One is, what are the stories where the economics of a higher gold price have got the most juice and leverage right now for producers or near producers? And the other is the better exploration stories with good management that has already shown an ability to raise money.
Great way to simplify it. I think it's so easy to get lost in all the different factors, but that is certainly a really good starting point for people to consider. So I'll set gold aside for now, and I want to move on to silver. So a lot of excitement for silver in the last couple of weeks or so, hitting highs of over a decade. I'm wondering what you think of this price move that we're seeing. Is this the start of a breakout? I know that people often say once you get past maybe that $35 level, there's not a lot of upward resistance. Or is this, silver being its volatile self and maybe we go back down?
Well, I regret to say that my exuberance on gold is not matched yet by my exuberance near term where silver is concerned. I was asked about this recently, Charlotte, and a lot of people point to the gold silver ratio and they say it gets to a certain point and it's too stretched. To me, and I always have to use this cornball example to make a point, the gold silver ratio to me today is as meaningful as the ratio of axle grease to Honey Nut Cheerios. Okay? It doesn't mean much. What we're supposed to see and should have seen long before now is with gold doubling in what has it been, 2 years or less, basically, whatever it's been. Silver should have done way better than that, just historically the way it would get dragged up with the gold price. But it didn't. And there's a reason it didn't. There's actually several reasons it didn't, which don't reflect badly on silver's long-term, fundamentals, which I'm very bullish on long-term. So don't misunderstand. But the central banks and others who are buying gold as a safe haven asset as opposed to buying treasuries, they're not buying silver. They're not stocking up on gold as a reserve asset, or on silver rather, they're stocking up on gold. So silver, regrettably, for this, present purpose of this discussion, is looked at as much more of a base metal. So it's lumped in with all the other base metals, and we're right now, you're kind of in a no man's land because we don't know if whether it's the tariff war or the shooting war between Israel or Iran, or finally either the Fed or the Bank of Japan not able to keep their finger in the dike anymore. We have a dike burst and you have a global recession for a while, which frankly we're overdue for because you had this huge credit super cycle. And the next logical move is to have a deflation for a while, which as usual, central banks are trying to forestall. But if we get something like that, then I don't care how good the fundamentals are long-term for silver, copper, nickel, whatever, they're going to go lower in price before they go higher. And so that's the kind of the no man's land you're in here right now. I do think the base case going forward is that we're going to have modest, plodding inflationary growth at best. And if we have that together without too much more trouble in the treasury market and the government somehow, I'm not holding my breath, is able to get the confidence of the markets on the debt a little bit more than what they've got right now, then I can make a case and say, okay, if the odds of a recession or a financial crisis have lessened, and they're going to keep papering over things. If they need to do quantitative easing again, they'll put a zero on the end of it and do this all over again. And now the price level for everything goes up. Okay, then we can be in a little bit more constructive, albeit long-term inflationary picture, where gold will now underperform all of the other assets. That's the point at which you'll see the gold-silver ratio right itself. Not so much because of silver's attributes specifically or because it's too cheap compared to gold, but because you will see silver going up with crude oil, with copper, with rebounds and, the nickel and lithium and things like that. Because the base case that people will have again will be, okay, the world's not going to end. We're not going to have a global recession. They'll print enough money to keep us all afloat. And that's about as good as it gets. And if that's as good as it gets and that's the environment, then you'll want to be in silver and base metals and actually de-emphasize gold somewhat.
Really good breakdown. I think it's a little bit of a different perspective than I've heard on silver. So great to go into that. So, yeah. But still a long-term story for silver.
Look,
yeah.
As with copper should be $8 a pound right now or $10 a pound to reflect the long-term supply-demand. Silver should probably be $70 or $80 an ounce, but you know what? Neither one of them are. And whether we like it or not, that's the reality of things. And that's the perception of the markets, And we all learn this lesson and relearn it over and over again, whether it's with an asset class or a stock. And I've been guilty of this from time to time. I have a stock. I really love it. Why doesn't anybody else see this that I see? Doesn't matter why they don't. What matters is they don't. And so if I'm all by myself over here with an opinion on XYZ company, and I think, gee, everybody's got to come around to my way of thinking. If they don't, I'm stuck. I don't have anybody to sell it to. Okay. And so that's the issue we have with some of these base metal stories. I actually think copper long term is more of a bargain than silver. I think uranium, still around $70 or so, after its correction that's been going on for the last year and a half, is the best story of anything outside of gold. But here again, uranium right now should be $150, not 70, but it's not. It will be, but it isn't right now.
And I think that's a good transition into uranium, which I really wanted to get your thoughts on. Yes, surprise, surprise. So uranium, that's another one like silver. We've seen a lot of excitement in the last week or so, especially with the Sprott Physical Uranium Trust $200 million raising. So I thought we could start there, get your thoughts on that. You're the first person I'm having a chance to talk about that with, maybe discussing the implications for supply and also the price.
Well, Scott Melby, who I'm sure you know also, he's the head of the Uranium Producers of America. He's vice president of UEC. He's a CEO of Uranium Royalty Corporation, pretty much the smartest guy in the U.S. when it comes to this industry. The last time he and I sat down for a recorded interview was beginning of April. And we believe now what we did back then, that phase 2 of the long-term uranium and nuclear energy bull market is starting to unfold. You've already seen it in like the SMR related stocks and the nuclear fuel stocks and things like that. There have been some really weird and quirky reasons why the uranium spot price has kind of been stuck in the mud for a while, but those are about to end. The Sprott move is probably going to help give it a nudge because, if you're looking at them putting in bids for 2.5 million pounds of uranium based on their recent raise, it ain't out there right now in the spot market. Not without the price moving up a whole lot. So, look, long term, what's really remarkable, Charlotte, about this whole story of this, renaissance for nuclear energy, is that you can look at copper, and we've all got our anecdotes about how many Escondida mines, like the big Chilean mine, need to be constructed in the next 20 years to meet demand, and they aren't there. Okay. You can look at silver and the long-term supply deficits. Uranium is just really remarkable because unlike some of these other areas where you can look at incremental bumps up in demand that are projected as the world industrializes more in certain places and whatever, the demand side for uranium just keeps getting more and more outlandish and spectacular. Who would have ever thought that we'd be talking about 3 Mile Island, for crying out loud, being resurrected? But Microsoft wants the juice from one of the reactors that wasn't damaged back in the 70s. You look at Amazon, you look at all these different things. At that New York conference I was at last month, I alluded to a few minutes ago, I chaired a panel on uranium and nuclear energy, and one of our panelists was talking about the application for small modular reactors and how this is going to be just a hugely transformative new technology the world over. And most of the existing charts are starting to catch up. Most of the existing charts and studies that match projected uranium demand with supply have never even factored in what's going to be added in years to come from all the demand for small modular reactors. It's all been utilities and the big stuff and that companies or countries rather have got in the planning stages. But you're going to see SMRs everywhere. You're already starting to see talk that they're going to replace power plants for large underground mines. You'll have one small modular reactor. So we've gone from dirty diesel to much less dirty natural gas or compressed natural gas. We won't even be using that. You'll have a little nuclear power plant run everything, and charge the batteries for your electric vehicles to go back and forth underground. It's going to be remarkable. I asked this guy on our panel because a few weeks before the SME conference, I was visiting one of my recommended companies out of northern Colorado. They have two projects we visited, one where they're finishing drilling some wells that they're going to complete and start fracking by late summer. The other one we visited, they're actually fracking the wells now. They're producing now. And what I saw, because I mean, I've been around my share of metals and mineral related drilling rigs and stuff like that all over this hemisphere, but I had never seen this kind of an operation in the energy industry. And it just blew my mind. You've got two F-16 jet engines that are the turbines running the power plant to produce oil and natural gas liquids, but mostly oil out of it. I think it was 9 or 10 wells, something like that. That's a monstrous amount of energy and juice and equipment needed. So I asked this guy in our panel, I said, I explained that anecdote, and I said, when are we going to have SMRs that the oil patch is going to want to buy? Well, that's already in the works. I said, well, okay, I would think it is. So this is revolutionary, and it's only going to add to the supply stress for uranium. So as you well remember, we peaked about a year and a half ago near $110, give or take, for the spot price of uranium. We were back in the 60s recently. It's in the low 70s as we're recording this. I'm sure Sprott's going to move the needle a little bit here in the coming not very many days. And that's just one of the things that I think is going to put a fire back underneath the uranium space. And people are going to realize that right now, and I'll say this unequivocally, to me, if I was looking fresh at uranium as a story today, I would be every bit as bullish at $70 as I was 4 or 5 years ago at 20. And I am every bit as bullish today at $70 as I was 4 or 5 years ago at 20.
That helps it, I think, be put in really good perspective. I'm wondering about uranium. So it's so clear that the big picture is very positive, especially as we move even forward into the future. But, you mentioned that quirkiness in the spot price. We've seen this pullback, and I think people get really stuck in looking at that and focusing on it and feeling a little bit uncertain. So anything you would add there for people who might be feeling that right now?
I would just look at the big picture and understand, too, that the spot market has not always been the best, barometer for how healthy the market is. In fact, even though it's not directly a holding anymore in my newsletter, we still have some Cameco via the URNM exchange traded fund, which we've got a good slug of. But, Cameco, we got in, at the bottom. I told people to sell it at 40 some dollars or whatever, because I thought there were better leverage plays and more pure uranium stocks, because nothing against Cameco at all. It's a wonderful company, but they're a quasi utility, and now they own their share of Westinghouse these days too, which is great for them long term. God bless them. It was a good move for them to make, even though a lot of people at the time didn't think so. But, they've got the last laugh. But I listen to their quarterly call. I listen to Tim Gitzel every 3 months when he's going over their finances. And I'll tell you what, the uranium market is way better than you would think if all you do is look at the spot price. You look at the contracts they're adding, you look at how much things are building up as far as the demand side, and utilities that have put this off and put this off, they can't put it off anymore. So between the existing demands, between new builds that are coming on and coming, handful of years, you're going to see a moonshot, I think. And I mean, even Scott commented recently, this is going to be a rip your face off rally potentially when we get this next big wave. And one of the advantages, I think, here, Charlotte, too, and people need to remember this, the overwhelming cost when you extrapolate everything for a nuclear power plant of any size, and even for the SMRs going forward, the cost of the uranium itself is relatively slight when you compare it to coal power, gas, anything else, really. And so if the demand side pushes uranium to $200 a pound in the next few years, which I think is quite possible, if not quite likely, you haven't rendered nuclear power uneconomic as a part of that. You've simply reflected the scarcity of uranium and how even with uranium scarce right now, and even with the price tripling, if it does that in the next few years, nuclear power is still going to be the best choice for 24/7, base load power. Natural gas is going to be a big part of this too going forward. I don't see any decline at all in natural gas fired generation in the world, and most people agree with that. The same company I visited out in Colorado there at the end of April, they love to point out the fact that we don't have an energy transition going on. We have an ongoing energy addition in the world. And overall, for transportation, for everything, the demand just goes up, 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 up every year. The mix is going to change a little bit incrementally from time to time. But, you and I are going to be long gone, and we're still going to have natural gas. We're still going to have oil, probably still going to have coal, but we'll have more natural gas, more uranium, maybe a little bit more renewables proportionally, but I don't even hold my breath on that.
I like that energy addition phrasing. I hadn't heard that before. I like it. That is all of my topics for today. But before I let you go, any final thoughts that you would share with investors?
I think that we're in for a real catharsis in the market, some good and some bad in the very near term, Charlotte. None of us alive today has ever lived or existed or done business or invested in a world that did not revolve around the United States of America as the chief global economic power and hegemon. And you've known me long enough and followed my stuff long enough. I don't get into all of the dopey conspiracy theories and sales pitches and, the dollar is going to be replaced as the world's reserve currency next week or any of the rest of this stuff. But as I said earlier in our conversation, a lot of chickens are coming home to roost. We're going to have a much less benign macro environment going forward. I think that so far, I would give President Trump a D- on his handling of the U.S. economy, which basically means his mishandling of it, all of the confusion that's been injected on the tariff situation. And look, there are things I like long-term about his game plan. I like that he seemed, at least for a while, to understand that the U.S. has got to extricate itself from so many foreign hotspots and whatnot and look to build our own hemisphere. I would love to see him embrace, which I think he does deep down thematically, what Ontario's Premier Ford has called this Fortress Can-Am, I think is the term that Doug Ford came up with. We have got within our own four walls in North America, and I think you have to include Mexico because they're an important trading partner. We've got the ability to drive our own bus going forward. And there are therefore a lot of strategic, urgent needs and economic and investment opportunities if we find ways to accelerate the move away from dependence on foreign sources of things and build up our own industries. In the U.S., the best story right now is uranium in that regard, and the president, with his recent executive orders, really has given an additional tailwind to that. But on a lot of other stuff, it's not so much. So that's a subject for another day to talk about our industrial and economic policies to make the nascent permitting reform actually mean something. And that's another thing I think people need to watch, because in the realms like we're in here, where people follow natural resources and things like that, there's been, in my opinion, way too much premature celebration over a few executive orders when those executive orders and those promises by Prime Minister Carney now up in your neighborhood to help streamline permitting, none of that made a development stage nickel project any more economic than it was before those things, which means they aren't. And so there's a lot of work that needs to be done. So we've got, what's the old saying? May you live in interesting times. We've got interesting times and perilous times at the same time. And great opportunities, but again, near term. And I think a lot of it is going to center on the U.S. Treasury market and the U.S. political situation over the budget. We could have much more of a mess economically and in the markets over the balance of this year, I am afraid.
We'll have to check back in with you and see how some of these things pan out. But for now, we'll leave it here. I think we covered a lot of ground. So thank you so much for coming on once again today.
My privilege as always. It's always good to see you, Charlotte.
Great to see you as well. And once again, I'm Charlotte McLeod with investingnews.com. And this is Chris Temple with The National Investor.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.